welcome to the Adjusted for Risk podcast here from the shores of Lake Tahoe. Today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed decisions. Since Zephyr's inception some 30 years ago, Zephyr has been recognized as an industry leader in investment analytics. This status has not been built overnight. It has been built on years of thought-provoking content and research, an unparalleled presentation of analytics that help investment professionals tell their story, and the creation of new analytics that help these same investment professionals tell their entire story, not just part of it. So through a series of Zephyr StatFact videos like this one today, I will help you make sense of some of these investment metrics that are used or maybe not used enough today and how they should be used. Some of you may be familiar with the Zephyr StatFacts, which was the creation or the brainchild of former Zephyr colleague Mark Otto. So I'm going to go ahead and take these fantastic resources and put them in a video format. There are a lot of great investment metrics out there that one can use. And in some cases, it can be a lot like alphabet soup, which can make it confusing in determining what metric an investment professional should use. So hopefully this series of StatFact podcasts will make it easier for you to determine what metric helps uncover different investment strategies, as well as helps tell your story to your clients and helps you make more informed investment decisions. So in this edition, I'm going to go ahead and focus on the very popular Sharpe Ratio statistic, which measures the trade-off between risk and return. So risk-adjusted return statistics like the Payne ratio and the Sortino ratio are very popular for numerous reasons. While these return versus risk trade-off statistics have a lot of similarities, they differ in how they define risk or what measure of risk they should use in the calculation. So for example, the Sharpe ratio uses standard deviation as the risk measure, while the Sortino ratio uses or focuses on downside volatility. And finally, the Payne ratio uses capital preservation statistic, which is the Zephyr Payne index, as its measure of risk. One of the primary reasons why I like using these risk-adjusted metrics is because they're not benchmark relative, meaning the calculations do not include a benchmark return, which allows one to compare two very different managers or compare apples to oranges, whereas statistics like alpha or the trainer ratio are relative to a benchmark, meaning that you should compare similar managers in order for the comparison to be relevant. For example, if you're looking at a large growth manager, you should compare it to another large growth manager. If you're looking at an international manager, you should compare it to another international manager. However, using statistics like the Sharpe ratio allows you to compare an equity manager to a fixed income manager to see what one provides the highest amount of return per unit of risk. Now, most people won't compare a equity manager to a fixed income manager, but for example, you can do that using a Sharpe ratio or another statistic like Sortino ratio. So on to the Sharpe ratio. The Sharpe ratio is the granddad of all return versus risk trade-off statistics. It was the creation of Dr. William Sharpe, who was awarded the 1990 Nobel Memorial Prize in Economic Science for his contributions to the capital asset pricing model. and his landmark paper, 1996 paper titled Mutual Fund Performance. In addition to creating the Sharpe ratio, Dr. Sharpe, in contributing to the capital asset pricing model, Dr. Sharpe also was the creator of returns-based style analysis. So the Sharpe ratio is one of the oldest and most famous risk-adjusted return metrics. In other words, the Sharpe ratio represents the added value over the risk-free rate per unit of volatility risk. Again, it's the added value over the risk-free rate per unit of volatility risk. So how is the Sharpe ratio useful? The Sharpe ratio simplifies the options facing the investor by separating investments into one of two choices: the risk-free rate or anything else. Thus, the Sharpe ratio allows investors to compare very different investments by the same criteria. Anything that isn't the risk-free investment can be compared against any other investment. The Sharpe ratio allows, like I said earlier, an apples to oranges comparison. So you might ask yourself, what is a good number? Sharpe ratio should be high. With the larger the number, the better. This would imply significant outperformance versus the risk-free rate and or a low standard deviation. However, there is no real set in stone breakpoint above, which is good, or below, which is bad. The Sharpe ratio should be compared against an index or an appropriate peer group. Keep in mind that it is possible for Sharpe ratios to be negative. If the investment has a negative return and falls short of the risk-free rate, the Sharpe ratio will be negative. For example, over the past year or year to date, chances are most Sharpe ratios out there today are negative. What are limitations? The Sharpe ratio defines risk as standard deviation. So it carries the limitations that are inherent to standard deviation. Standard deviation fails to differentiate between upside deviation and downside deviation. Also, a standard deviation does not take into account the timing of returns. While standard deviation is the granddad of volatility statistics, there are shortcomings, and that's why there's other statistics like downside deviation, which only measures bad risk or risk below a breakpoint, like cash or zero. Whereas standard deviation, for some people, upside deviation or the risk or the volatility above zero might not be bad. So you have to take that into consideration when you're looking at Sharpe ratio. If you don't like the fact that standard deviation penalizes both upside volatility and downside volatility the same, you might want to look at the Sortino ratio, which just focuses on downside deviation, or the Payne ratio that focuses on capital preservation tendencies of a manager. What are typical values? Historically speaking, fixed income investments have offered the best return versus risk trade-offs. When defined by the Sharpe ratio, international stocks have fared the worst once volatility is weighed against return. So not surprising, fixed income typically has the best Sharpe ratios, while international stocks, because they have typically inherent larger volatility or risk, has the worst Sharpe ratios. Sharpe ratios were lower in the 2000s compared to the 1980s and the 1990s, featuring two large bear markets. Many equity asset classes really struggled or even failed to outperform cash during this decade. Some Sharpe ratios were negative in the 2000s. So that gives you an example of the Sharpe ratio. Another very popular return versus risk trade-off metric. When to use it, like I said earlier, I think you should always consider using one of the return versus risk trade-off metrics. It's a very informative statistic. Now, which one, whether it's a Sharpe ratio or Sortino ratio or pain index, really depends on you and how you want to quantify risk for your client. If you have a client that's older, who's more concerned about capital preservation, you'll probably want to focus more on the pain ratio. Whereas if you're a client that really doesn't worry too much about, downside deviation versus upside deviation, or good volatility versus bad, then focus on the Sharpe ratio. Or if you have a client that's really more worried about downside deviation, that's the bad risk, then focus on the Sortino ratio. So it really depends on what type of your client you're trying to do an analysis for. So with that ends this episode of Adjusted for Risk with the special episode Zephyr StatFacts edition. So you can watch this on our YouTube channel, Adjusted for Risk. You can also listen to this on most podcast distributors like Apple Radio or Spotify. And finally, you can also catch more of our insights at A Wealth of Insights from 6,237 feet website. And thank you once again for joining and listening. I hope you all have a great rest of your week. Thank you.